Welcome back, everybody, to another episode of Built to Scale. And we have back with us Rachel here. Technically, for everybody to be aware, we totally recorded these on the same day. But, fact is, we really wanted to get Rachel's insight from a previous episode into cash and versus accrual basis accounting. Today, we're diving into a topic that seems to be very common of contractors that have grown a business and are looking into real estate development outside of that construction business, that finally they have the solid cash flows from their existing business, and they would like to venture into real estate development as well. Maybe that's the end game plan itself, or maybe those are just side ventures, but ultimately they're venturing out and doing that. And so really super grateful because this is Rachel's expertise, that this is what Rachel has done with other contractors and has navigated this and helped manage those development projects. So super excited to have you back with us, Rachel, and that we could dive into this topic too.
Yeah, I'm very excited to chat just further today, and especially about real estate development. As you said, it's something I'm very passionate about. So,
Yes, awesome. And for our audience to be aware, if you're just listening to this episode, like I said, we had a previous episode with Rachel. Rachel is one of our team members at Brady CFO. So she is one of our fractional CFOs. And so super excited to have her on here. Like I said, this is a very common theme, it feels like, Rachel, that, the reality, there could be multiple motivating factors for it that, really the contractor eventually wanted to just get into development anyways, and this was kind of a pathway to do that, or they enjoy development and just like to do it on the side, and or it's a tax management strategy, right? And a general investment strategy that they would have had spare cash and they could have thrown it in the stock market. They decided to do real estate development instead because of potential returns of leveraging their own skill set and all that. Definitely a tax management piece to it in several instances too. But um, there's a lot of reasons why. I kind of highlighted some of those, but why do you think that a lot of contractors dive into this? Like, what are the reasonings? What are things that they should be considering? Why could it be a good option for them?
yeah, well, I think you did a great job of summarizing some of those. Certainly, the contractors that I've worked with are entrepreneurs, right, at heart. And so they have the entrepreneur spirit. They're curious about other business ventures. I feel like oftentimes they're riding the coattails of a developer. And so they're understanding to some degree how the developers are successful, and they're helping build that. And I think the efficiencies that can be gained through, managing a project at more than just one step of that project, right? And so as they continue to want to try to grow and build their business, it oftentimes feels like a natural next step for them is, how can I expand this? Okay, well, I'm a contractor. I know how to build. A hotel, an apartment complex, a commercial building, or do some TI renovation type project. And so it makes sense for me potentially to go ahead and build that building and own it long term, and or apartment complex, hotel, whatever the case might be. So but I think at the core of it, what I've seen more times than anything else is just the entrepreneurial spirit, right? They're curious about other businesses. They're wanting to continue to grow and expand, and also, possibly some diversification. And then certainly, and you hit on this also, the tax benefit, right, can be really significant depending upon asset type and how much revenue they have. There can just be some really great tax advantage.
Yeah, I mean, we've certainly stepped into situations where, it's a little bit tough to model it out perfectly over 5 to 10 years, but at least in a single year, given some depreciation, strategies and tactics that, some clients we've seen, they've had great operating results in their contracting business, and we've literally wiped out an entire tax bill for that year, right? I mean, that's what we're talking about, and yeah, I'm interested though because I think we've also seen, and that's what we're really going to dive in, is the considerations of how to do this well. At the end of the day, contractors, yeah, they have the know-how experience of how to build the building. There's a lot of other things to consider here. That, yeah, the entrepreneurial spirit, and by all means, I'm almost wondering if we should do this because I feel like sometimes ignorance is bliss when you're an entrepreneur. Like,
Yeah.
just like you don't know, just keep rolling. Like you'll figure it out, you know. And I always tell sometimes our sometimes when we've walked into the most messiest clients, I'm like, the fact that they had no idea financially where they were at probably was bliss, and they just kept going and they were confident. And like the fact of not knowing probably helped them just be confident. And but there is risk to real estate development. I mean, all types of risk. I really want to understand from you, especially your depth in this area. What are the risks for contractors to consider?
Yeah, so I think, one of the first and most significant risks is just spreading themselves too thin, right? With capital, with their time and energy, and even sometimes with their team, right? You don't understand exactly how much it's going to take. You're super optimistic and how quickly you think it can be accomplished, and what you think the potential project costs are, and everything's really rosy and things are going great until they aren't. And then now you've multiplied your issues or challenges to overcome because not only are you the contractor and trying to get paid for the construction portion of things, but you're also the owner and responsible for bridging any gaps. And so, just being really cognizant of keeping those two business interests separate from each other and ensuring that they both can stand on their own, and knowing again, the knowledge is power. And so how did we really perform financially in constructing this project, and then also me as a developer and an owner operator, how am I doing under that business venture, and keeping those two very separate, having a great understanding of how those two operate, and also being careful not to hamstring one for the other, because I think oftentimes that's what happens. I find myself, backed into a little bit of a corner or between a rock and a hard place, and now I'm needing to make a decision where I'm prioritizing one organization or goal, business venture over the other, and just spreading myself and my resources too thin. So, I would say that is just one thing you have to be so cognizant of, and continue to manage and keep line of sight on.
I think you're absolutely correct. Is just you may have a great primary contracting business, and I've seen it time and time again in multiple different industries. But it could be a great idea of the development venture. It's just it is going to pull resources from that primary business, and your first rodeo, you are probably going to underestimate what that really looks like. I mean, especially if you're sharing team members, could you burn them out and could they leave you, right? From a financing perspective, the moment you have other entities, no bank is going to look at your primary contracting business in isolation anymore. When they make a financing decision for that business, it is no longer in isolation. Like it is no longer, but that business is doing great. The real estate development project, not so much, but that one's great. Can you make sure we get financing for that? It's like, nope, they're going to look at the whole sum of things, knowing that you're probably taking resources from the one that's doing good to fund the other, right? And yeah, I want to dive in here, further because we're kind of, anecdotally saying some things about our experience with this, but let's kind of dive in here that, cash management. What are some of the considerations regarding cash management that should be considered in real estate development? And we're going to go into multiple things for our audience to understand. So yeah, let's start with cash management. What are things that our audience really needs to consider?
So, I mean, real estate development is just so cash intensive. It's very, very cash intensive. You're taking on additional risk as it relates to interest rate risk, and to your point, the banks and the financing risk. And we've seen this certainly over the last couple of years. But, as soon as the market, there's a little bit of instability within the markets, the banks are maybe coming back and saying, oh, we sort of changed our mind and we thought we were going to close this loan, but now, we need some additional equity from you. We aren't completely comfortable with the project costs. Construction is obviously there's a lot of fluidity in the pricing there. And so just making sure that you are adequately capitalized to get started on a project and to ensure that you have appropriate contingency to ensure the project's success. And then we can't forget real estate development on the back end then is an operating business, right? And so you have the risk of lease up and operating costs and just ensuring that you have appropriate management for that, that you're taking care of that appropriately, and an appropriate contingency for if a lease doesn't come through on the timeline that you thought that it was going to, or you have construction delays and now your interest carry is going outside the original window that you underwrote it for. There's just all of those things are going to take additional capital, and they're oftentimes unforeseen, or we're thinking about things through rose-colored glasses, and we really need to be realistic in what our expectations are, conservative in some of our underwriting assumptions, irrespective of maybe what the banks will allow. And oftentimes the banks are extremely conservative, but still, just making sure that we're planning appropriately from a cash perspective. I would say the cash management, cash is king, especially when doing real estate development. Um, you can get through a lot of challenging times if you're adequately capitalized and you have the money to put into it. It's a situation where you're not, and the bank's making demands of you, and now you're operating from the place of weakness and needing to appease them. That becomes extremely challenging and just no fun for anybody, right?
I guess I'm interested to understand from your vantage point, right? Because like there's market, things that go into all of this too. And sometimes we deal with clients where they're just the ultimate entrepreneur, and like, hey, like the opportunity, there's this perfect opportunity, like on a silver platter. At the same time, um, their primary business has to be in a solid state. If you're up to your eyeballs in debt and hand to mouth in regards to your primary contracting business, it's going to be tough to say, hey, go into that real estate development venture unless somehow you finagled a deal where everybody else puts the equity in, and you don't have to put a bunch of cash in, et cetera. Those are very hard to come by. But like, where would you want to see their primary business, their personal liquidity? Where would you want to see those things kind of sit, Rachel, to be in a comfortable position that knowing that there's going to be cash demands, in the real estate development, that they're not going to potentially kill their primary business, pulling out dollars to try to make the real estate development work? Like, where would you like to see the primary business sit to really be in a position to start considering projects?
Yeah, I think if they can achieve what they would like to within their operating construction company with the liquidity that they have, minus whatever they need to go and execute on these projects. But certainly, and I think this goes back also to the entrepreneurial spirit, right? I'm wanting to build everything all at the same time. I'm wanting to continue growing my construction business, maybe my bonding capacity. I'm making asks of the banks and financial institutions, and I'm also maybe not planning appropriately for the growth that I want. In addition to, I'm trying to strip a bunch of cash out to go and do some of these side ventures. And so I think it's important, in accounting for at the beginning of a project, let's just, go ahead and account for that missing liquidity and working capital. And where does that position us? And is that going to cause heartache and heartburn with our surety? Like, start having those conversations preemptively rather than waiting until the surety gets your financials. And now you're having a difficult conversation on the back end as to why do your financials look like this? Well, just plan appropriately, ensure that you're having those conversations with your partners. They can also help guide maybe some of those underwriting assumptions and operating assumptions around what you're really able to do given, most likely what your cash constraints are going to be. And so I think just making sure that you're having those conversations, making sure that you're planning appropriately and accounting for it. Unfortunately, we see clients who start a project and I think they feel like they're well capitalized within their construction company and without a lot of planning, maybe just start pulling cash and loaning it to themselves. And, I think that's where your third party, that's where you get yourself into trouble, right? When you just aren't planning appropriately, you don't have great line of sight, and you just start every month every month that continues to grow, and you're doing your best to get the project done, but it's just everybody starts to get kind of anxious around the lack of clarity as to what you're trying to do and how you're going to get it accomplished.
Yeah, 100%. I I like, I mean, because, liquidity can be a broad term, right? But I like to see that, hey, even if they pulled, a subset of cash out, that they would still be able to maintain a certain current ratio. Like it'd be obviously well in excess of one, but somewhere between 1.25 to one in terms of current assets to current liabilities. Like I personally like to see that even after they pulled out, what they think that they would need. And uh, take what you think you'll need and probably add 1.5 on that, and that's the real number of what you need. And if you pulled that out of your operating business and you still maintained a current ratio of, that 1.25 to 1.5, you're probably going to be okay. It'd be great if you could get with your CFO, you know go do a cash flow forecast and see, does this put us in a position where we really haven't had to borrow on our line of credit, but it's now going to require us to, because that's probably going to be a stinky thing for the bank to see. Hey, you're pulling cash out and I'm supposed to be lending that business, and you're pulling cash out. It feels like I'm lending that business over there technically, because you're drawing on your line of credit to go fund it over there. If you could do a cash flow forecast, I like to see that, hey, this isn't going to cause us to draw on the cash flow or on the line of credit in order to fund this project. The line of credit is supposed to be there for seasonal needs, for, hey, if a client pays us late. But if something demands that we'd have to start drawing on this and it's related to the development, yeah, probably not a good sign, right? Or at least the banks and everybody else would probably not enjoy that. And so, but yeah, I totally agree with you. I think sometimes, I don't know about your experience with it, Rachel. Like sometimes if you have a great surety rep, they'll give you a point blank answer. Sometimes I feel like they can get a little bit scared of, like they don't want to give you a firm answer because they don't want to be held liable for, hey, if you went down that road and you said, well, I told, you said we could do this, and then it turns out, differently. They may not, want to get too involved, but I would definitely like talk to your bank too. Like, hey, if we did this, you guys feel comfortable with this? And if you get the green light, um, that's not a perfect sign that all is okay, but it's a nice sign, right? And let's dive in, because we've talked about cash management. Cash management's related to financing. What are some of the financing risk in some of this?
Well, I mean, development loans require a lot of equity. Sometimes that can be a bit of a moving target, and then, the duration in which it takes to get from, I've identified a parcel of land that I would like to purchase, to I've built something, it's stabilized and operating can take many, many, many years, right? And so I think just the patience, the amount of capital that it might potentially take, and how long it might take for the stars to align and for you to be ready to execute on that project. And so I think just planning appropriately for that too. If I'm executing on a real estate development project and I know that everything has to go off just perfectly for me to make this performa work and for this to cash flow and be a successful project. Well, that's not the place that we want to get started from. It just you're positioning yourself to potentially face some really big challenges and potentially hamstring your operating company, which really is most likely what positioned you in the place to be able to do this in the first place. So I think just um having a really good relationship with your bankers, understanding to, positioning your performa to be somewhat conservative, stress test it, right? If interest rates do this, if my equity does that, if the project costs go through the roof for tariffs or one reason or another, right? We've seen all of these things that I think would have said, "Oh gosh, never in our lifetime would COVID be a thing, or would 25% tariffs be a thing," or all of the things that happen that really affect these projects, and oftentimes they're larger projects. And so I think just making sure that your assumptions and your goals and capacity within your organization, yourself personally, just making sure that all of those things are aligned and you're planning appropriately.
I don't like to give, like spiels or I guess, how do I say, like, to advocate so much for just accounting and finance resources all the time. But there is a reality. Um, I mentioned it previously in my experience that the moment that you start doing these other projects, your bank for your primary business is going to want to understand what's going on. And they're probably going to be the first party that you talk to, granted, to try to finance that other project. And I get it. So they're going to be aware, but the reality is, if maybe the way that you're funding that development project is you happen to have a cash balance, in your personal bank accounts or whatever, and you put it into that piece of real estate, yeah, it's still collateral, but it's a different form of collateral for the bank, right? And they're going to want to understand what's going on over there. And so even if you broke apart the banking, that maybe the bank that does your development project versus the bank that you use for your primary business, which, some businesses do that from a diversification standpoint, making sure that they get access to capital from multiple sources, have, relationships, irons in the fire with multiple parties. But if it comes to that, just I, I just the advice that I have to business owners is understand whoever's lending to your primary business, they are now going to have to understand with what's going on globally. That they are going to want to see everything globally, which also demands you're going to want to have some good accounting for that development project. Like, don't do it lightly. That I'm not saying that you have to go get a CFO for it, but rather just make sure that you are recording things in QuickBooks and you have some visibility into what the heck's going on and the status of the project, and you're able to account for it, because just be prepared that your bank is going to want to have that global perspective. And if they start to lack visibility, it's really easy for them to go look at a bank account with, I don't know, $500,000 in. They could say the value of that is $500,000. It's a lot different when they're going and looking at a development project to say, this is the real value in the marketplace at this point in time. And so they're going to want to have visibility into things. Just understand the moment that you start doing this, the banks are going to want to have a global perspective on everything. So be prepared for that and make sure that you have some dedicated counter resources that will take care of this development project, both for you internally as well as third parties like the bank. Um, I think, as we're navigating through this, Rachel, that what can a contractor do to best position themselves to be ready to invest and manage real estate developments? Like, how can they make sure it's like you said, if they're probably in a position where, oh, all the stars have to align, then probably not a good idea. But how, if they're not there today and they're thinking, this is what I want to do eventually, what steps can they be taking now to get themselves in a position to be able to do this when the timing is right?
Yes, absolutely. Well, I think the first one, at least for their core business, is just the financial discipline around, understanding their margins, where they're really successful, maybe where they have challenges, and ensuring and building that team and making sure that that really is kind of the cash cow horse behind all of this. If that ultimately is their goal, right, is to try to maximize margin and get their construction company really up and running, and then pull some of some of those retained earnings to invest in other projects. It's really important that they're making sure that they're disciplined, that they're holding their team accountable, that their team's operating really well. Also, if it's going to require that the business owner pay more attention, or that their attention is going to be kind of divided between two business operating entities, the current team that they have in place, is there capacity there to kind of take over and for that business owner to be less involved in the operating company? And I would say, if the answer is no, I have to be involved, 60 hours a week in my construction business. Well, then start looking at how do you build up your team? How do you get them to a point where they can run that construction company and you can be a little bit less involved, or have parameters, framework in place to ensure that you're comfortable with the way that things are being managed and operated, so that you can uh, kind of turn your time and attention to something else, without worrying about it hamstringing that other business. And then I would say just putting an appropriate plan in place, making sure that your financial capabilities and expectations are aligned with whatever real estate asset type you're potentially looking at, right? Do you have adequate capital to go and execute on a $10 million project, right? If my project's $10 million and, even if I say somewhat conservatively, like 30% uh, equity into it, do I have that money today? Is that going to hamstring my operating company? What are my expectations on return of capital from that money? So, but everybody sort of has to understand what their long-term goals and expectations. I've worked with some contractors who are trying to create reoccurring revenue so that at some point they don't need to rely on the construction company for that any longer. Well, that, expectation is a lot different than I want to build and stabilize and sell something and roll and continue to reinvest, that profit into my next two projects and continue to grow the real estate development company. So I think that's really important. And then also understanding globally how this is going to affect, your surety relationship and how they're looking at you along with your banking relationships. If you're in a position where your long-term goal is to continue growing your surety program, well, your surety's not going to love you taking out a $7 million loan potentially, depending upon how well capitalized and how much working capital you have currently. So, but I do think there's other financing mechanisms. I think I've worked quite a bit with like the HUD 221 D4 program, which is all non-recourse for multifamily housing. So I think again that goes back to the plan and understanding what your long-term goals are, having conversations, and just making sure that you're keeping your expectations and goals and capabilities kind of all really well aligned as you plan for your project.
That was all really great, and um, I lost my train of thought. I had like an insert idea I wanted to add in there, but sadly my kids are coming home and all this stuff. So the joys of being podcasting from home, right? But no, this was great, and I especially the HUD financing program that you mentioned there. That really interesting insight. That what are all the parameters of that? Can you explain that a little bit more for our audience?
Yeah, so it's a federal program, and it's market rate, but new multifamily housing. Um, it's the underwriting process is quite arduous, and to get through the process itself is, but for some contractors, it can be a really great solution. So it's a 40-year fixed rate. And non-recourse. So there also then is a BISPRA credit. And so you get some equity and credit for being the, owner, developer, and contractor. And so it can just be a great solution for some, depending upon the years in which you were underwriting and where interest rates sat at the time. You know, Lower equity requirements than maybe you would see in the marketplace otherwise. But, that can be a great tool if you're trying to stay away from any recourse debt. Obviously, it comes with its own set of caveats and challenges to work through with that program. But like I said, I think that's where the creating a plan and really understanding what your long-term goals are and sticking to those. I think unfortunately what happens is you say, "Oh, I want to do a real estate development project," and you're talking to all these other entrepreneurs in your entrepreneur groups, yes, and they say, "Oh, I've got, this project over here," and kind of, "Ooh, okay, well, I thought I wanted this and this well aligned, but somebody brought me this opportunity and I think it's going to be really great and I should get involved in that." And so it's really um maintaining the plan and understanding what your what capacity you have. If your capacity really is a $10 million project, don't try to stretch to a 15 or $20 million project, right? Start on a smaller scale, a little bit simpler. I know that doesn't often or always resonate with an entrepreneurial contractor, right? They're like, "Ah, I can do that, right? I've built it for other people," and so it's hard to say no or to take a breath and go, "Is this really what I should do?" Does this really make sense? Is it really well aligned um, with where I'm at right now and what my original plan was? Or should I wait and maybe the next opportunity is the right opportunity for me? So I think just being very thoughtful and careful. And like I said, these projects oftentimes uh, you know, can take 10, 20 years, depending upon what site you're on and some of the entitlement requirements and how big you think this project has the potential to be. And so I think just making sure that you're planning appropriately before you get started, being very careful and cognizant of what the risks are is so important.
100%. I think you might have mentioned in there, I think I heard the word partner. And I just for our audience, and I know Rachel and I have been in this too. Um, especially when you're looking at the equity requirements, et cetera, it may sound really great to bring in partners. It may be great to bring in partners. Please do your due diligence on your partners. Real estate project is just the same as owning a business and getting into bed with them. Please do due diligence on your partners, even though that you may have known them for years. Rach and I have both experienced situations where people have known each other for years, and one party discovered the other party has some serious skeletons in the closet that were never brought to the table that really affected their ability to get the financing and everything that they were seeking to do. Please do your due diligence on your partners. Just want to make sure that that's evident for our audience here. But Rachel, I so appreciate. I know that we could probably talk, like we probably need to set up a separate episode where we go and deep dive into some of this stuff even more. But I mean, it's funny because we did the episode on cash versus accrual basis, and I feel like that's just the nature of like what we do. Like it's kind of a necessary evil. I could tell, like in getting into this episode with you, like you were passionate about real estate development. Like I could just see it as we were talking. So I am very, very grateful that we had the time to chat, and we really should actually dive into some of these elements even further. That maybe even by asset type and considerations, under those things, and dive into little nuances of this deeper. But it was wonderful to be able to have you on and get your insight.
Oh, thank you. Yes, I thoroughly enjoyed it and would look forward to any time, you know, continuing this conversation. But I think, as you said on other episodes, reach out if, something we said today spurred a thought or a question, or you just want to talk a little bit further. These are the things that we love to talk about, right? It's our passion in our work. And so I just appreciate the opportunity.
Yep. Awesome. Thank you, Rachel. Appreciate y'all. Hi, everyone. So if you enjoyed today's episode and you found value, or it raised some questions for you about the next best steps for managing your finances in your construction business, please reach out to us at bradycfo.com. There's a contact page there where you can fill out, and that will come straight over to us. Either that, or you can personally find me on LinkedIn. My name is Mason Brady, and feel free to send me a message, and happy to chat and talk through anything you're facing today, and happy to provide some advice. So thank you all. Appreciate it. See you.